Tom Lee's Bitmine just earned $45.7 million from Ethereum staking in a single quarter. Meanwhile, MicroStrategy holds more than 842,000 Bitcoin, and all of that Bitcoin produced precisely zero in native yield. So, has Tom Lee just proved that Ethereum is better than Bitcoin as a corporate treasury asset? Well, not quite, because during the exact same quarter that Bitmine generated record staking revenue, the company still posted an $83.6 million loss. And the reason for that loss is not what some headlines would potentially have you believe. Ethereum may genuinely be a more productive treasury asset than Bitcoin, but that does not necessarily make Bitmine an automatically better investment strategy than MicroStrategy, or even more simply, owning Ethereum over Bitcoin itself. Now, that may sound like a lot of different versions of the same question, but they're not, and separating them is where the real investment thesis begins. And as always, a quick disclaimer here. This video is for educational and entertainment purposes. Nothing here should be considered investment advice. You should always do your own research and understand the risks of any investment decisions you make. And at the same time, as this brief pause, I'd just like to take a quick second to ask you to please like and subscribe this video. The last video I recorded had over 99% of the viewers unsubscribed. And by liking the video and subscribing to my channel, it tells YouTube that you'd like to see more of my content, which would really help a lot. Now back to the video. Despite the name, Bitmine is no longer primarily a Bitcoin mining company. Under Tom Lee's chairmanship, it has transformed itself into the largest Ethereum treasury in the world. Bitmine now approximately holds 5.81 million Ethereum tokens and holds a cash total of $11.6 billion. Bitmine owns 4.8% of the total ETH coin supply of 120.7 million. Bitmine also has 5,067,000 staked ETH, representing $9.8 billion at $1,928 per ETH. 5 million ETH at its latest reported annualized yield of 2.63%. That position was projected to generate $257 million per year. If the entire treasury is eventually staked, Bitmine projects that could reach $294 million annually. That number is not guaranteed, but potentially hundreds of millions of dollars in revenue. Generated from an asset that the company intends to hold is an extremely powerful idea. And this exposes a fundamental difference in Tom Lee's Ethereum strategy and Michael Saylor's Bitcoin strategy. Bitcoin is optimized for monetary simplicity. It has a fixed supply, a predictable issuance schedule, and comparatively to ETH, much fewer moving parts. Ethereum, on the other hand, makes a different trade-off. Holders can commit their ETH to validating network transactions. In other words, securing the network using their tokens and making it more secure. In return, they get rewarded in more Ethereum tokens. That makes Ethereum a productive crypto asset. It does something. And that matters. And that is significant because treasury companies have expenses. They have employees, custody, and debt. And they also have preferred share dividends. If the treasury asset produces zero yield, then the liquidity must come from somewhere. Just like with MicroStrategy, when in May 2026 this year, Strategy sold 32 Bitcoin, raising approximately $2.5 million. According to its filing here, the proceeds were expected to help fund preferred share dividends. Now, 32 Bitcoin is virtually nothing compared with MicroStrategy's total holdings, but symbolically it mattered. When MicroStrategy needed liquidity, its Bitcoin holdings could not create that liquidity itself. Meanwhile, Bitmine can earn additional ETH and potentially sell those rewards rather than selling the principal treasury it holds itself. And staking rewards are paid in Ethereum, not dollars. So the asset essentially produces more of itself. But Bitmine may still need to sell some of those rewards to cover its own cash expenses. And now we reach the most misunderstood part of Bitmine's results. During the quarter, Bitmine generated revenue from staking and validation of 45.7 million, representing 98% of total revenue of 46.5 million for the quarter, meaning that Ethereum staking represented approximately 98% of everything earned. However, Bitmine also generated $37.3 million worth of general expenses, including custody, treasury management, salaries, and share-based compensation. It also recorded 15.4 million in unrealized digital asset losses. That left Bitmine with an operating loss of approximately $11.9 million. But the largest hit came from derivatives. Bitmine lost $92.1 million on derivative contracts. Approximately $14 million came from exercise options and another $78.6 million from options that expired. That is the critical correction. The $83.6 million loss does not prove that Ethereum staking failed. Ethereum produced exactly the revenue it was supposed to produce. The wider financial vehicle and machine, however, consumed more value than the staking created. And honestly, that makes the story a little bit more interesting, because even a productive asset can still be undermined by poor capital allocation around it. And again, if you're enjoying this type of breakdown, where we start to look under the hood of some of the company's financials and understand what it really means, don't forget to like and subscribe. But there is another challenge to the Ethereum native yield narrative. Where does the yield actually come from? A significant part of the staking reward comes from new Ethereum created by the protocol in a process called minting. The official Ethereum developer documents here tell us that Ether is minted as a reward for each block proposed and at every epoch checkpoint for other validator activity related to reaching consensus. It's a really technical kind of way of saying if you stake your coins and risk them to say that basically the next set of transactions was actually true and valid, you will get some sort of reward for that. So yes, some of the yield is issuance. We also learn here some of the rewards can come as tips from transaction fees and MEV related income, but these come from recycled Ether and not new issuance. So describing staking as pure external income would be misleading, but calling it meaningless inflation, on the other hand, would also probably be very wrong. Validators, which is part of the network that Bitmine operates within, are performing a necessary service of securing the network itself, essentially making Ethereum secure. Staking protects holders against protocol-level dilution. It represents a real economic value flywheel, but it is not a fixed interest payment. The yield can also fail, as more and more validators may join the network. As we can see from this segment of the documentation, the more validators, the greater the overall issuance, but the smaller base reward per validator. These factors influence the APR for staking nodes. Read the rationale for this here. In other words, the more validators, the lower the return. In April, Bitmine reported a yield of 2.88% and projected $330 million from the full deployment. But by August, the yield had fallen to 2.63%, and the projection had declined to $294 million. That's despite Bitmine owning more Ethereum. So that headline figure is essentially just a live projection, not a promise. Which brings us probably to the most important comparison, not Bitmine versus MicroStrategy, but Bitmine versus owning and staking ETH directly. If you own Ethereum directly, you can already access its staking economics. So Bitmine has to offer something more, and potentially it does. Bitmine provides ETH exposure through a traditional brokerage account. It can use capital markets to accumulate more Ethereum, and Mavan could eventually become a genuine institutional infrastructure business. But those advantages are entirely on execution. Between August 2025 and May 2026, Bitmine's outstanding common shares increased from approximately 232 million to almost 580 million. That is an enormous convention dilution, but issuing shares is not automatically destructive. If the capital raised increases, the amount of ETH backing each existing share can also increase. So the crucial metric actually is ETH per fully diluted share. Investors must also compare Bitmine's market value with the value of its underlying assets. At a large premium, you are paying extra for management, Mavan, and future execution. At a discount, the corporate wrapper may become more attractive. A strong concept can still be a poor investment at the wrong valuation. Bitmine's new 9.5% preferred shares also create a cash requirement that the staking revenue is intended to support. Those shares came after the quarter, so they didn't cause the $83.6 million loss, but they highlight Ethereum's potential advantage. Bitcoin Treasury companies must fund cash obligations from reserves, external capital or further investment, or sales of the asset itself, e.g. Bitcoin, whereas an Ethereum treasury can produce additional Ethereum to help cover them. Regulation is also becoming less threatening than it once appeared. In March 2026, per this document, the SEC formally identified Ether as an example of a digital commodity. It also stated that the protocol staking activities it described does not involve the offer and sale of a security within the meaning of Section 2A of the Securities Act or section of the Exchange Act. Accordingly, participants in protocol staking activities do not need to register transactions with the Commission under the Securities Act. Despite that though, operational risk still remains. Validators can be penalised or potentially deceased or slashed rewards if they perform incorrectly. Ethereum produces yield by introducing more moving parts. Bitcoin, however, avoids all of those risks entirely by producing no native yield at all. So has Tom Lee proved that Ethereum is better than Bitcoin as a treasury asset? If the question is which asset can natively generate additional units and protocol level revenue, then potentially yes. Ethereum wins on that comparative element, but if the question is which asset offers the simpler, more predictable treasury model, Bitcoin still has an extremely powerful argument. Bitcoin might do less, but it also offers fewer opportunities for things to go wrong. So therefore, is Bitmine a better strategy than MicroStrategy? Not automatically. Bitmine may have the superior income mechanism, but its derivative losses, dilution, and evolving capital structure show that sophistication of the wrapping vehicle can cut both ways. Is Bitmine better than owning Ethereum directly? That also depends on the number of Ethereum held per fully diluted share, its premium or discounted net assets, the success of Mavan, and whether management consumes more value than it creates. And this is my personal take. The important revelation here is not that Ethereum is better than Bitcoin or vice versa. It is that potentially native Ethereum yield gives Ethereum treasury companies a structural advantage. But equally, Bitmine's results prove that advantage can be overwhelmed by what management builds around it. Bitmine didn't lose $83 million because the staking failed. It's because the wider financial vehicle wrapper consumed more value than the staking made. That demonstrates that Ethereum's productivity is real, but it makes Bitmine's execution really the investment thesis. So I'd love to know your thoughts. Does the simplicity of Bitcoin still make it the stronger term long hold? And if you wanted Ethereum exposure, would you buy Bitmine or hold ETH directly? I'd love to know your thoughts. And if you've enjoyed this video and you want to explore more content in relation to crypto, capital markets, tech and blockchain technologies, please make sure to like and subscribe to my channel.